In this video, we are going to look at on how to use the market indicators to detect market bottoms. The first question is, what are market indicators? Market indicators are based on the data of the entire market instead of individual or group of stocks. Now, what are the indicators which we will be using? We will use three indicators, namely the buy volume, the sell volume, and the AD ratio, or the advance decline ratio. Now, let us look at these indicators briefly. Buy volume. Now, how do we determine the buy volume? Because in the market, for every buy there is a sell, and for every sell there is a buy. Here we will use a proxy. The cumulative volume of all the stocks which gained on that particular day will be our proxy for the buy volume. Similarly, the sell volume. The cumulative volume of all the stocks which lost on that particular day will be our sell volume. The third indicator is the AD ratio. Of course, this indicator is a widely used indicator and does not require explanation. Still, it is the ratio of the number of stocks which gained to the number of stocks which lost on that particular date. Here on the screen, I have the chart of the Nifty and two indicators. The upper indicator is the buy volume of the whole NSE, and the lower indicator is the sell volume of the whole NSE. Like I explained before, each bar in the buy volume represents the cumulative volume of all stocks that went up on that particular day, and the sell volume represent the cumulative volume of all stocks that lost on that particular day. As we can see, the bars of these indicators are colored differently. Most of the bars are of gray color. In the buy volume, some of the bars are of green color and some are lime, and some of the lime bars have a square on top. In a similar manner, for the sell volume, some of the bars are colored red and some are colored orange, and some of the orange bars have a square on top. Now, let us look at what these colors signify. If the buy volume is 3 times the sell volume, then the bars are colored green. If the buy volume is 5 times the sell volume, then the bars are colored lime. If the buy volume is more than 5 times the sell volume, and at the same time the advance decline ratio is 3, more than 3, in other words, if the advances are 3 times the declines, then you have the square on top. In the same manner, if the sell volume is 3 times the buy volume, then the bars are colored red, and if the sell volume is more than 5 times the buy volume, then the bars are colored orange, and if the sell volume is 5 times more than the buy volume and the declines are 3 times more than the advances, then you will have the square on top. Let us recap the rules for the coloring of bars. For the buy volume, if the buy volume is 3 times the sell volume, the color is green. If the buy volume is greater than 5 times the sell volume, the color is lime. If the buy volume is greater than 5 times the sell volume, and at the same time the advances are 3 times the declines, then you will have the square on top. In the same manner, for the sell volume, If the sell volume is 3 times the buy volume, the color is red. The sell volume greater than 5 times the buy volume, the color is orange. If the sell volume is greater than 5 times the buy volume and at the same time the declines are greater than 3 times the advances, then the square on top. Now let us see what these colored bars represent. These colored bars represent significant buying or selling days. The green and the lime bars tells us that there has been significant buying, but it may be confined to a few sectors as the advance decline ratio is small. But if we see a square on top, it tells us that the buying has been overwhelming and it is spread across the market and not confined to a few sectors. In the same manner, the red and orange bars tell us that there has been significant selling, but it may be confined to a few sectors or groups of stocks as the advance and decline ratio is small. A red square on top tells us that the selling has been overwhelming and it is spread across the market and not confined to a few sectors. Now let us see how these indicators will help us to detect market bottoms. Let us go back to February 2018, where we saw the index fall about 600 points in a few days' time. The fall was marked by huge selling on the 2nd of February, where the sell volume was 40 times the buy volume and the declines were 15 times the advances. Soon, on the 8th, we saw some significant buying which arrested the deep fall. Then again we see some more buying coming in here, but the selling continued. The buying was not enough to push the index above the price rejection levels of 10,550, and the selling continued again here, though we see intermittent buying that was not enough to totally arrest the fall. Here again we see lot of selling coming in, which pushed the market down to sub 10,000 levels. Here the selling accelerated and we can see an exhaustion gap here, soon to be followed by lot of buying coming here. You can see here all the buying coming here and the selling waned here. So when the fall was there, you can see lot of selling, and when it got arrested and the up move started, you can see lot of buying coming in. This change from huge amount of selling to huge amount of buying clearly indicates that the downtrend is over, the market has bottomed out and the index has started moving up. So this marks the beginning of an uptrend. So we can use these indicators in such a way to detect the market bottoms. One interesting thing to note here is that the BPA software or the BPA AFL clearly identifies the market bottoms. As you can see on the 27th of March, clearly says possible end of downtrend and the start of the uptrend zone with an uptrend arrow. So the VPA software has been quite successful in detecting such turnarounds in the market. Now let us look at one more example. In the month of May, we saw the index lose about 400 odd points. The down move was marked by huge selling, as you can see here, and here the buying started coming in, and it was continuous buying which arrested the down move, and the index started moving up again. Here also, if you can see, the VPA software clearly says possible end of downtrend and the start of an uptrend zone. So like I said, the VPA software has been quite successful in identifying such turning points from downtrend to uptrend. These market indicators also warn us when an uptrend is likely to end soon. For example, let's look at the uptrend which started in December 2017. You can see a lot of buying coming here. Though the market was moving sideways, still we could see huge amount of buying here. So it is clear at this juncture that the market is likely to go up because a lot of accumulation is happening here. As expected, the market has started moving up, and here you can see a huge amount of selling where the sell volume is 5 times or rather 6 times the buy volume, and the declines were 5 times the advances. But the index did not move down too much. The spread was also narrow, so it was more of a discrete selling happening. A distribution has started taking place. Here again we can see huge amount of selling. Then we see sort of a climax move with 3 F4 to move bars. After that you can see here that the sell volume was dominating here compared to the buy volumes here. It's a clear indication that the uptrend is likely to end soon. This is all now regarding market indicators. There will be more later. Thank you for watching this video. Please send your comments and opinions to karthikmador@outlook.com.